Recording going, all things go. Got a little robot do the reading, we'll be all set.
Access to this webinar is for educational and informational purposes only. Consult a licensed broker registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither philstock.wells.com, CSW, nor its affiliates, nor any of the respective offices. Personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. CSW provides education and training services that are meant to teach you to the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on a specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
Okay, got that out of the way. All right, how's it going, guys? So the markets are popping at the moment. Let's see what's going on. Trump is right this minute talking about how he wouldn't benefit from his tax plan. It's for you. So let's keep that in mind. I am getting totally hosed, though. I hung on to my TS. I thought we'd get rejected around here. We didn't. That's 10 points. That's a $5,000 loss. I didn't want to look. Down $12,000. I ain't pissed. Let's see. I only have 10, though, so I could go more, and I think I'm going to start adding a few. Now notice every time I do that, I go up on 58 now. I want to see what I can get it to. I want to go 58 and 60. 60 is good for now. So 60 is now my break even. And I'm going to leave that, and hopefully we don't pop over 80. That would really suck. So let's see how we do. If we can get back to 60, that's kind of realistic that we can come back that far. I'm not pleased, though. I didn't want to have 10 in the first place, but we've never gotten a good enough pullback for me to get out of the 10 that I have. So I'm stuck here waiting for something to happen. You know, we're heading into the end of the quarter, so, you know, there's a tendency to push the indexes up into the end of the quarter anyway, but this is above and beyond what's going on right now. I mean, this is a huge spike. And oil's still up. Oil is 52.12 with oil. I'm down on that too, but not so bad. So moral of the story is don't listen to me right now. I'm calling it completely wrong. So anyway, I still think oil is going to come back down. I'm willing to give that one time. And the Russell here, all right, so I have 13 at 60, and we're at 79. So we're 19 points higher than my average. So if I add one, I'm only going to go to 61 now. I only change my average from 60 to 61 if I add one around. That doesn't make it very enticing to add one. If I add two more, I'm only going to bring it up to 62. I don't really think there's much difference between 60 and 62. So it's really not worth, at this point, adding more. See, every time you add another contract, you diminish the effect of the new contract. Now, of course, if we're popping over 80, that's not good. So Trump is just on TV right now selling the tax plan. But this is, you know, this is what today's excitement is about, is a tax plan. And there hasn't been a rebuttal to it. There hasn't been any sort of, nobody's come out against it or anything like that yet. So it's all positive news, and everything is spinning positive, and lower taxes, the story is going to be more profits for corporations. Not that they pay taxes anyway, but that's the story that's going in. I mean, that's the funny thing about it, because if you look at it, let's see. Corporate taxes. 2016. Well, I don't see that we're going to get a total out of this thing. Oh, I guess corporate tax revenue. Let's try that one before we give up. All right. So, out of so corporate taxes, $473 billion last year. That was 13% of all revenue. That's on about $3 trillion in earnings. So just it's 10, it's 12. What is that? Is it 15%? Might be 15%. That's pretty good actually. I mean, not really, but better than 12. So let's see. On 3 trillion, 473 divided by 3,000. Yeah, 15.7%. So that's effectively what corporations are paying. But the real problem with corporate taxes, and this is where it's very, very misleading, is the corporations. As a percent of revenue, 13. See, notice the corporate tax has just consistently gone down and down and down and down, while individual taxes just keep on moving along. There's other charts here. This one will show you. Here's corporate profits. Corporate profits, on the other hand, skyrocketing, while the taxes that the government collects, this green line taxes collect down here. So the government collects much, much less taxes on much, much more profits ever since Bush changed the rules over here. Huge differences. And it just keeps getting worse. So, a huge part of the hole in our budget is the fact that we're just simply not collecting this much corporate tax, which is, probably $1 trillion a year. Probably our entire budget deficit is caused by lack of collecting corporate taxes. Trump is proposing to lower the corporate tax rate significantly. I don't know, frankly, since they're cheating now, it's hard to say if it's really going to make a difference. What if I really thought he was going to close all the loopholes and lower the rate, I'd probably be even for it. But there's no way to know that's going to happen. If he leaves the loopholes open and lowers the rates, then they'll pay less. But, so the big, what's that? That's not, what on earth is that? Anyway, so the big thing, though, is that it's the big corporations pay very little taxes. When a corporation, I'm a corporation, Phil Stockbroker's a corporation, we pay the regular amount of taxes. The big corporations pay 0% taxes or get refunds or do all kinds of wacky stuff. I'm not eligible for any sort of bailouts or federal funds or matching funds or this or that. You don't get that. But the big corporations take advantage of every little loophole and do everything they can to avoid paying taxes. So when you see this overriding corporate tax rate, a large majority of those are corporations. Now, as a middle-class business, as a business owner, not middle-class, but as a business owner, I would love it if they lower the corporate tax rate. That's fantastic. But I just worry about what we're going to be collecting from the it's really all about what we collect from the larger corporations. I mean, the money made by small businesses, which are for the most part break even, or their subchapter S or the chapter S corporations that you turn around and pay your individual taxes anyway. The savings are minimal there, but what the large corporations pay is what's in question. And Apple alone, who's I don't think Apple's a big tax avoider. Let me see, AATL. I mean, they keep their money overseas, so that's different. But if you look at Apple financials, the stuff they declare here, they've got $45 billion in profit. I'm sorry, 60. So their operating income is $60 billion. Their income is $61 billion, and they're only paying, look, income tax, 20%. They're only paying 20% now. Isn't that amazing? How is it possible that they're only paying 20% now? If Trump's telling you he's going to lower the rate to 20% from 35%. So that's what they pay on the 20. Let's say that Apple doesn't pay 50 anymore, they pay 10. There's $5 billion out the window for government revenue. And for what? You're taking it from the people who need it the least. So meanwhile, though, money's money, right? So what's going on now is that the traders are revaluing the market, and they're saying, well, lower taxes means more profit. More profit means we can now raise the bar on the indexes. And that's what's going on. So this is the knee-jerk reaction is to just ramp things up. But I think obviously this has all been baked into the cake since Trump was elected. We've already had a 20% market rally on the expectation of the thing that's happening now. So how are we still rallying more? It's already baked in. So we'll see. Anyway, so at the moment, though, I'm wrong. I've been shorting, and unfortunately, I picked the Russell. If I shorted the S&P, or if I shorted the S&P at 2,500, or if I shorted the NASDAQ at 6,000, I'd be in good shape. But I didn't. I shorted the Russell because the Russell has been the best mover on the way down. So I'm now stuck in this position that I'm not happy about. Now, I could switch, but I still think it's not that unrealistic. My average is here at 60. It's not that unrealistic that we'll have a pullback, so we'll have to wait and see what happens. And the Russell, we were talking about that yesterday. Where's yesterday? That's not yesterday. I had a really good chart for that. We were talking about the relative size the index is. There. Aha. So here's the thing about the Russell. The average S&P 500 company is 549. No, that's not the average. I'm sorry. The average is $113 billion. I'm sorry, not in the S&P 500. The Russell 1000, top 1,000 companies average $113 billion. The average of the Russell is $1.7 billion. It's almost like it's like 100th the size. So I think I did the math yesterday. What did I say? Oh, I see. So this I was using this math up. This is 549 billion over here, and this is 2 billion over here. Anyway, so you're talking about it's 100 times smaller, 1/100th the size of the S&P in valuation. So if money flows into the market, the Russell disproportionately gets a lot of it. Okay, when people make index bets and buy lots of companies, they're buying a lot of this is what's happening with all the ETFs that get traded these days, is, certain things are in multiple ETFs. So if you buy XRT, you're buying some small caps, you're buying some large caps. If you buy the XLE, the energy, you're buying small caps, you're buying large caps. These things float around a lot. So the Russell will disproportionately get bigger when money's flowing in and get smaller when money goes out. That's why it seems to lead the indexes. It's really a quick indicator of which way the money's flowing. So it's basically the smallest pipe, and it has the largest effect when money starts flowing in it. That's why you see that outsized effect of the Russell. And so when we have a pullback, we'll probably have a nice pullback too. But unfortunately, if you're in it, it sucks, which I am. GME, if you bought the stock today, what 2020 options would you sell to offset? GameStop. Let's take a look at it first so that we can be on the same page. I like GameStop. I really didn't think they would do as well as they have. They've adapted well to the changing environment. And, wow, they are low, though, aren't they? They're down at 20, which has got to be good for them because their earnings are not that bad. Hang on a second. Let's take a look. GME. See, earnings not growing, revenues not growing, but like I said, they're adapting to a changing environment where more and more game sales are going online, and so they're selling more of the consoles, and they're selling a lot of specialty stuff. They sell a lot of subscription stuff. They're changing their model to suit it, but they're still making $353 million. They are valued at $2 billion. So honestly, they're making 1/7 of their market cap. So that's, it's kind of weird, right? And let's take a look at the analysis. I bet they've got to be making $2 a share, right? $3 a share. They're making $3 a share. And the analysts, current year 2018, that's interesting. Why would 2018 be the current year? They must have a weird year. 377 this year. People think it's going down, but you know what? Going down isn't a horrible thing when it says cheap. So, what would I do? I wouldn't bet them to go on a tear because their business is declining, and it's hard to say. Now, how is that going to get fixed? That's the question. So, if you think about it going forward, okay, what's GameStop going to do to increase their revenue? You've got more and more apps instead of games, instead of traditional games. You've got more and more phones instead of consoles and things like that being used. This augmented reality stuff, it's all going to be app-based sort of thing. They'll probably do more with the Oculus sort of thing, with the virtual reality, because that's something where kind of you need equipment. So they'll probably do more virtual reality, Oculus kind of things. But, even that, most of the games are sold online. So it's kind of tricky for them. If I was them, I would buy the empty mall space and make large-scale virtual reality spaces, for people to play in. Because there's so much empty mall space that you could buy cheaply and do stuff like that. It would give them more of a presence, of a place. But either way, so the niche is shrinking. It's hard to say what would make it grow again, what's going to make people physically need to go to a store to buy stuff for games. That's a little tricky, and I don't see a clear path. So I would play them conservatively. That's thing number one. See, when you ask the questions, like first thing I figure out if I want to play them conservatively or play them aggressively. I would play them conservatively, but I'm pretty happy with making $3 a share on a $20 stock. So if we go out to take a look at the option chains, and this is what we're going to talk about this today, because this is the point about, we're talking about being the house and how you play these things long term. Here's a good example. It's a stock. We're not super gung-ho, but it's a nice stock. Now, so they're at 20 now. Would I own them for 15? Oh, yeah, for sure. Now, would I own them for 17? Sure, I'd own them for 17. Would I own them for 20? I would almost own them for 20, especially with that discount. But here's the thing. If you sell these puts for $5 or $5.70 was the last sale, if you sell these puts for $5 or $5 whatever, let's split the middle. What's it? $4.40, about $5.20. So let's say it's $5.20. You're selling for $5.20. You're netting into $19.80. And frankly, not $19.80, $14.80. And frankly, $14.80, I would just sell the puts and forget about it. If you end up owning it, you own it for $14.80. If you don't end up owning it, you keep the $5.20 for nothing, which is 1/3 of your risk of owning them. So you can make 33% in 2 years for doing nothing but promising to buy it if it goes below 15. So that's a nice play there. The problem is if you start getting more aggressive and adding a bull call spread or something like that, now you're spending your $4 and you're getting close to that $20 price. So I would rather, since I don't mind buying them for 15, I'd rather sell the $15 puts for $2.50. Because then, even if you use the $2.50 on something else, your net is still 15. So you're in no worse shape than if you kept the money on the 20s. And now we can make an aggressive play. So Now you can buy, let's see. These are wide spreads, so it's really tricky because not too many people are transacting. The $15 calls, this is 4 and this is 8 basically. So 6 is in the middle, so yeah, $6. So let's say you buy the $15 calls for $6 and you sell the $20 calls for $350. You know, be conservative. Well, probably more than $350, $370. So anyway, so 6 and $370 is $230. So for $230, you can buy this. So that's what I mean. So for $230, you can buy this spread. It's a $5 spread. I'm sorry, not $5. Yeah, $5. The 16-20 spread is $2.30. So it's a $5 spread. You're buying that for $230. Then you offset the $230 by selling this for $230. So for $250, you have a 20-cent credit, which is fine. And then instead of making only $250 at 15, you don't make anything at 15, but if it does stay above 20, you're going to make $5. You're going to make twice as much money. So it's more aggressive than just selling the puts. Oh, I'm sorry. It's more aggressive. I'm sorry, but you need the same 20. So no, I would just sell the puts. I think you're jumping through hoops for no reason. So that's my answer officially. I would say sell these calls for $5 or better. You know, maybe $5.50 if you can get that, and that's the $20. Sell the $20 puts. So you're going to net in below $15, and anything above 15 you make money. Otherwise, you're just sort of like constructing trades that there's no particular reason to do it. You know, in other words, you're not going to make much more money, and you're laying out money you don't have to lay out. This way, you're not laying out anything. You're putting $5 straight in your pocket. You're going to have the margin of the obligation, but you're going to have that anyway if you do a bull call spread with a short put. The same basic obligation either way. So this way, you just play the obligation, collect your $5, and be happy. So that's how I would play that one. But again, I'm not excited by it. It's nothing. I don't have a clear path where I think GameStop is going to be good. Now, that being said, I'm pretty sure we have GameStop in our portfolio somewhere. Let me reboot this. I'm pretty sure it hasn't been relogged. There we go. And long-term portfolio, GME. Yeah, see, we have the stock. Oh, I forgot they pay a dividend. See, that's nice. What do they pay? Oh, they pay $1.52. Holy cow! No wonder the stock doesn't. No wonder it doesn't go up. Paying $1.52 is a lot. I'd be worried they're going to cut that. Wow, that's why we bought 1,000 shares because they're paying $1.52. We're like, well, why not? Now, what did we do? This is similar to the other trade we were talking about this morning with GE. We bought them at $25.75. We sold the $20 puts. Oh, we've since bought back the short calls. We figured they were going to go back up. We sold the $20 puts, and I'm sure we sold the $20 calls for about the same price. So we basically netted in at about 20, and then we're just playing it to collect this money. So we were waiting for a bounce to sell more short calls, and now that the 2020s are out, we'll have to consider it. Now, if we do sell the short calls, let's take a look at what we can collect. So we go back to maybe I like this. I assume I will like this setup better because maybe I like it better because that's what we ended up doing. In 2020, look at that. We can sell the $20 calls for about $350. Well, we already talked about that. We could sell the $17 calls though for $5 at least. That's kind of attractive because that knocks our basis way down. So we'd be taking, to get the money that we already made, we'd be taking $8 off what we sold. So we're knocking our basis down to 17. So even at 17, we're at worst case break even. If we get called away at 17 from starting at 25, and we're going to collect those dividends for free, and at that rate, we're collecting like a 10% dividend while we wait. Now, of course, when it actually gets to this time, we're not necessarily going to get called away. We're going to roll them or do whatever. Like let's say we had sold the 20s All right, forget that. Let's say we sold the 17th of this January. So here's January. Here are the 17th. They're $4.10. So where would I roll that to? What's 410? 410 is a 20. So I could pick up $3, which is 15% in position. I can pick up $3 more and roll the short call. They still have the coverage, and I collect 2 more years of dividends. So you see how that works? It's not like you definitely get called away. It's a fluid thing. It's like a chess game. There's a move, and then another move, and then another move, and another move. And you have to watch as the play develops over time. But when you have a dividend stock and money is constantly pouring in, and so the longer you keep playing, the more money you make. That's the trick. And that's really the beauty of the system working it that way. So that's why we went into GameStop. We love stocks that just pay us a fee. By default, we get a fat dividend, and everything else is just sort of gravy on top of the dividend. So I really like that one. But again, we're not playing it to be exciting. We're playing it very conservatively. And when it was 25, we sold the 20 puts, and those 20 puts are about even. We cashed out the calls, the short calls, because we thought 20 would be a bottom. And now we're waiting to see what actually happens before we sell more. So, yeah, we just recently sold. We bought back these puts because we thought this was getting kind of silly. And now we'd like to see maybe 22, 23, 24, somewhere around here. When we think it's looking toppy, we'll do another cover and sell. Because that's always, we're looking, you always want to be selling premium. How can I sell more premium? That's where we make our money. Whether the stock goes up and down is separate from whether or not I'm collecting more premium. How do we exit the TVA hedge, please? What TVA hedge? That's the question number one. So specifying, we'll talk about it. So a pullback on TF is not plausible. No, it's not plausible. I'm playing for a pullback, but it's getting difficult to see when it's going to happen. I mean, look at, we're over 1480 now. So, we have the end of the month coming in a couple of days. So really Friday is the end of the month for trading. So until then, I don't really see a big pullback happening. So we're going to have to be patient on this one. And like I said, at this point, I don't have enough benefit in adding more short positions to play it that way. So we're just going to have to wait and see what happens. All right. Oh, a pullback to 1,400? Oof. Let's see. Okay, so we're at 1,480. 1,400 is way down here. So people have to really lose faith. Is it plausible? Here's the 1,400 line. Very plausible. Look at this chart. Over, down, over, down, over, down, over, down, over. It's kind of implausible that we're not going to test the 200-day moving average. But look at the time that we spend over. Okay? These are weeks. So here we have 1, 2, 3 weeks before falling. Here we have, 1 month, 2 months, 3 months, 4 months before falling. Here we have, I'm going to count this as being part of it, 1, 2, 3 months, doesn't even fall all the way. So that's like 4, 5, 6, 7, 8 months later, it finally hits the 200-day moving average. And by the time it hits it, it's quite a bit higher than it was. And here we have a top that you have to say would last 1 month, 2 months, about almost 3 months. So where are we now? We're on week 1 of making a new high. How many times has the Russell reversed quickly from a high? None. Okay, so you have to be playing this patiently. It's not going to reverse tomorrow. You're not going to get all even or anything like that. This is a long-term thing. You see this guy? He's not exhausted. He's not, this has to get up around, generally you want to see this thing get up around here, above 60. And that's where you're going to start seeing, see how these signs look? See how it gets up here, gets up here. Now here it didn't, but that's beside the point. But I'm saying if you want to be sure it's going to turn, you want to be up in that zone. We're not there yet. You can't be sure of anything. Plus, we're just having a pretty slow build. So let's look at IWM because they do a predictive thing. Wow, it's incredible. They have a number. They don't really have a number that they predict. Sometimes they predict where it's going to go. But it's the same. I mean, you're just not. You're in an early run up here. It's possible it's this kind of thing. See this blow up, like it went from 133. Well, it didn't go from 133. It went along the 135 line. It blasted to 140, came back down, blasted back to 140, close, came back down, up to 140, back down, up to 142, back down. So, these are dailies at least. So there's a little more hope that this will get tested. But I'm playing for 146. And I'm worried about that. You're talking about you're talking about whether it comes back to 140. That's just unrealistic. I mean, to expect that to happen easily is not realistic. It'd be. I mean, something would have to happen really bad for this thing to suddenly drop back. What's 80? You need 80 points. So 80 divided by 1,480. 5%. You're looking for a 5% pullback. We haven't had a 5% pullback in this market in God knows how long. So, in fact, I think we did have the pullback in the Russell here. Yeah. So we did have a 5% pullback in July. But look, this was after quite a prolonged, exhaustive period of testing the top. Then it finally pulled back. So it's very hard to say this. It's certainly going to be tricky to have a good outcome if you're waiting for 1,400 to show up. When you typically buy back short puts, I have many with 40% premium left expiring in 219. All right. As a rule of thumb, all right. Okay. How are you going to put this? 2019 has 16 months left before 2019, roughly. So in 16 months, you're going to collect 60%. I'm sorry, many with 40%. I'm sorry, you're going to collect 40% that's left. Question number one is, do you have anything better to do with the money? How sure are you? So let's take a look at. Let's say Apple is a good example, actually. Apple. All right. Let's say we sold the Apple. Oh, my God, 82. This is really getting hopeless. Let's say we sold the Apple 2019. Try and find one where the math works. All right, here you go. These guys, $4. So let's say we sold the 115 puts for $10, and now they're $4. Okay. The things you want to think about is, first of all, what if you switched it? Where's your comfort zone? How low do you think Apple would go? So this play is going to make $4 divided by 16. And again, I'm fudging the number, but just trying to make it easy. Calculator. Here it is. All right, so we got $4 divided by 16. This is going to make 25 cents a month. Wow, I should have done that in my head, right? So let's say instead we wanted to sell, well, certainly the 130. So let's say I'm not worried about the 130s. I can get $11 for that. Or I could go for the 2020 140. So are you really, for the next 2 years, not at all worried Apple's going to go below 140? Because if you are, then the point's moot as to how much you're collecting. All right, so let's say 130 is extremely comfortable. And you go up to the 130 puts from the 115 puts. And if you went to the 130 puts here, they'd be 750. So you're only going to collect 1120 over here. But now it's 1120. 1120 divided by 28 months. That's 40 cents a month. All right? So you can collect, instead of collecting 25 cents a month, you can collect 60% more per month by switching to the 2020 130 puts. And if you have the same amount of comfort in those as you've had in the 115 puts, maybe it's worth rolling. So you have to consider that. Okay, you can increase your monthly premium collection by doing it that way. Yeah, so it's a combination of things. It depends on the stock, how comfortable you are with it, whether you have anything better to do with the money, and also your overall expectations. So, in other words, is it worth what you're tying up to make, in this case, $4 on Apple? Now, $4 is not much money. I could short instead. Let's go back. We always talk about my favorites, so let's go back to limited. LB still in contention for the trade of the year, although it's moving higher. Limited brands is only $42 instead of $150, and I can collect $4 selling the 35 puts on limited brands. What would I rather sell? And that's only 2019. So what would I rather sell? Would I rather sell limited brand for $4 and collect, or you can sell twice as many for $8, whatever. But would I rather sell limited brand and collect that money, or have the open Apple puts? Which one am I more comfortable with? Which one is going to bring me more money? Which one's going to generate it faster? All right, these are all things you have to take into consideration. That's why there's no definite answer to it. You have to have a plan. How much money could you make versus how much money could you make on something else? And that's always how you have to consider it. It's always going to be a trade-off. There's a certain point, as a rule of thumb, I was going to say, as a rule of thumb, whenever something's up 50%, you have to really start considering whether or not it's worth keeping for the last 50%, especially if you have less than half your time is left. If you're up 50% and you still have 3/4 of your time, you should be more inclined to take it off the table. I assume that's the case with yours, right? But then you have to, like I said, then you have to start considering, what are you really doing with that money? Is it worth it? Do you have a better trade to go in, or are you just doing it for the hell of it? Are you actually worried Apple's going to pull back and hurt you on those puts? Well, you're not saying Apple, but I'm saying Apple. But the stock you have, are you really worried it's going to come back and burn you, or are you just doing it because you think it might be an overdone trade? Now, once you get to like 75%, there's hardly going to be a good reason to keep it. Once you get to 80%, and even when you get pretty close to the end, once you're up 80%, there's hardly anything left to gain. It's most likely you're going to be able to find something better to do with your money. Now, in our portfolios, we often let things expire because we have so much margin sitting around doing nothing because we're mostly in cash, that what are we going to do with it? It's like throwing money out the window if we don't let them expire. So it also depends on your overall situation. Do I like CTB, KMB, and Mo as put sale candidates because of the high yields? I don't know what they are on all of them. I know Mo I like for sure. There's no question on that. So as to KMB, what do they pay? 3%, and CTB? CDP. No, what was the other one? CTD. That's what I thought. CTD. Campbell. So that's 3%. So it's not thrilling dividends. So do I like them because of the higher yields? That's not why I like something. I like something because it's a bargain. So the question is Campbell's a bargain? I don't think Campbell's is, frankly. I mean, as you can see, a P is 29. 14, I always check. I never trust what they say. $14 billion, and they're making $500 million, so the P is about 28. Okay? That's pretty in line. They've got declining profits. They've got declining sales, so there's nothing exciting about this company. And they're not trading cheaply. So, no, nothing really there that I would grab onto. KMB, in this case, well, I don't know what the value was. $40 billion or $41 billion. And they are making $2 billion, so another one with about 20 times earnings. And again, flat sales, nothing exciting going on here. Earnings are picking up though. Now let's find out why. Why did their earnings suddenly double? They must have. I assume. Look, the earnings before taxes, SG&A. Look at that cut in SG&A. Wow, that's where their money came from. So the question is, did they really do that? Did they actually cut like 40% of their SG&A in a year? I find that hard to believe. So I'd have to look into it and find out if that's a real story or not. But even if they did, though, they're still trading at a very strong multiple of where they are now. So this year they're due for $6 a share. They're trading right about 20 times the $6 a share. So last year I wouldn't have touched them with the 10-foot poles. They would have been trading at 40 times earnings on the same price last year. So I don't know. It kind of stretches my imagination how they could have possibly cut 40% with such a small impact to their actual earnings and stuff. It's possible they sell, consumer goods. Maybe they automated. Maybe they did some cool stuff. But still, that only puts them in line for like a reasonable thing. So then you say, well, what do you want to do with it? So KMB. So the question is, do you want to sell puts? I mean, what do I really feel about KMB? If they drop 20%, would it make me want them more? Not particularly. And 20% would be like $40. So let's say 80. That wouldn't be worth it for an $80 to probably get an $80 stock. Unless I'm getting like this is almost $4, assuming you can get that much. So if I sell the 90 puts for $350, let's say. How good is that? And that's in lieu of buying the stock and collecting the dividends, of course. Because if I buy the stock for $116, my dividend is $3.88. It's $4. So you're talking 2 years worth of dividends is $8. And I'm trying to see if there's a way that I can collect $8 without buying the stock. I'd have to sell the 110 puts. That doesn't seem like it's worth it. And that's the bottom line for me. So I get that far, and I'm pretty much going to say to myself, I don't like them enough to sell the 110 puts. So if selling, see the other one in GameStop, selling the naked puts was so attractive that I would do that by itself. In KMB, it's not as attractive. It's just not that exciting of a thing. Now Philip Morris, of course, is different because Philip Morris. Well, let's look at the numbers first. Tell you what. So MO, not NO, MO. MO. So $122 billion company, small, not small, but a 4% dividend is fine. Not profile, financials. All right. They're dropping, remember, they're $102 billion. This is a totally different picture. $14 billion to the bottom line. But that seems unusual also. See, this is like that's probably not right. What do they do? Oh, I can't take all these people. Total income, other expenses, net. What the hell? Earnings? So it's this thing. So then we have to find out what they did here. That's the problem. You can't take everything at face value. But meanwhile, I do like them. I mean, they earn they're earning $3 a share. So the PE on these guys is about 22. Now, the thing I like about Philip Morris of Altria compared to the others is I think eventually these guys are going to start selling pot. And these guys operate in the U.S. So eventually, as pot legalizes, I think they're going to start selling pot. And I think that's going to be massive additional income for them down the road. So I can see a way. Also, they're into the vaping. They're catching all the things. I think they're a good, flexible company. They do the sin stocks. And look, you can say Kimberly-Clark, not Campbell's. Campbell is soup. I mean, to me, that's not something I'd really invest in. But Kimberly, of course, they do everything. So they're an everything company too. They adapt with the times. Altria certainly adapts with the times. And I like what they're doing. I like the company in general. They're just a money-making machine. So in other words, if they got cheap, if they dropped 20%, I don't mind owning them. So at $55, I'm kind of excited to own them at that price. Long term, I think they're going to last. So that makes me more inclined to sell a put on Altria. And they don't have 2020s out yet, but I can sell the $55 puts for $3. That's pretty good money. I could sell the $50 puts, the $60 puts, and net $55, which again I like the money at $55, and I can get $5. So you see, I'm collecting. It's got a better profile than the other two. So given that set, that's the one I would go for. I'd start with selling those puts. I don't have any particular reason to think they're going to fly higher, but I do, in the long term, think they would. So when 2020s come out, I'd probably be inclined to take a spread, and probably a speculative one. So in this case, I sell the $60 puts because I really believe that this is a fair price for them and they'll go up. I don't mind my net 55. But as far as speculating higher, again, the thing I think is going to happen is that they're going to have sell pot. So I'm just going to speculate of an upside spike that would be very apparent if they change what they're doing. So if I take the $65 calls, which are out of the money at $4.80, let's say, and I sell the $70 calls at $3, so that's what I say, $4.80. So $4.80 minus 3 is $1.80. So I'm taking $1.80 of the $5 I'm collecting, and I'm taking a $10 spread, the 60-70 spread. Wait a minute. No, I'm sorry, it's a 65-70. Maybe I want to go 72.50. I take it back. So let's try that. 480 minus 240 is only 240. It's still fine. So I spend 240. I'm spending half of the money I collect on the puts. So I still have 250 net on the puts, and it puts me in at 57.50 if I'm assigned. And I'm going to have the $10 spread just in case they pop. I'm not going to regret it. The 65.70, 250. So you see how I'm looking at that? I'm covering bases. I'm saying, well, and again, I wouldn't do it in 2019 because there's no imminent thing that makes me think that it's going to happen now. But I think a couple of years from now, very, very possible there's enough of laws changing where they may start, at least in certain states, they're going to start dipping their hands in these pot products. They're just waiting for the laws to stabilize, and then they can. All you got to do is go in wherever there are pot businesses. They just won't buy them. They got tons of money. It's not like people are going to turn them down. So they don't have to be the first mover in the space or anything like that. They're so gigantic that they will always be able to buy their way into the business. So they're just waiting for the regulatory hurdles to be clear before they do that. But I strongly feel that's where they're going. Oops. What are we doing here? We talked about those. GME, 7.1% dividend. Yep, except I'm not sure it'll last. You gave the October 14.50 16 debit call spread. Oh, that was something recent that we did. That was, that's that's got to be a disaster. 14.50 and 16. Yuck. The 1450 calls it down to 30 cents. So the only thing you can really do here if you want to salvage it, and I don't remember what they were at the time, but I figure they couldn't have been more than like 75 cents or so. You can salvage the 29 cents you can salvage out of the 1450s and use it to construct a longer term position like 13. So let's say we move down to the 13s, which are $1.90 something. So let's say 195, and then we could sell. I don't know about 16. Let's say you sell the 15s for $1. So then you're netting 95. So for 60 more cents, you can move into the 13-15 spread in January. Now you still have the open short October calls, but we're kind of writing those off. We're figuring we're not likely to get back to that. But I would keep a very tight stop on the 15s. Was it? I would keep a stop on these at like 30 cents to make sure you don't get totally burned. So I don't remember the original price, but basically, let's say you got in it for it could have been more than $1.50, or I wouldn't have done it. You have to make at least 100% on the spread. So if the original spread was a 13.50-15 spread, or let's wait. Is that what you said? $14.50-16. Sorry, the original spread was a $1.50 spread, so we couldn't have paid more than 75 cents for it. Or again, I wouldn't do a spread that didn't make double. So if the original spread was 75 cents, let's say, and you're collecting 30 cents back, so now you're into net 40. All right. What we're going to do then is then roll. So you've lost 40 cents. That's a carry cost. Then we roll out to January. We pick up the 13s, which are in the money, for $1.90 something. Let's say $1.95. I'm being pessimistic too. I really don't think you should have to pay that much, considering it's down $1 today. But it's $1.95, and then you're going to sell for $1. Or let's say sell for 95 to 16, something like that. So your spread should be about $1 on the 14-16 spread. Then you're in the 14-16. The 13-15 spread. Wow. Oh, and that clearly is $1. So then you're in the 13-15 spread for like 95 cents. So you lost 40. You're buying a new one for 95. That's $1.35 now you spent on a $2 spread. Now, the good news is, though, that it's going to make the same pretty much 75 cents if it pops back up. So you put a little bit more money in, you're buying more time. But the point is it's insurance. So in theory, if you're using the hedge properly, it's insurance, which means you have other stocks that are doing well. Your bullish position should be doing well. This is insurance in case something doesn't do well, which so far has not happened. And as I mentioned this morning, like our long-term portfolio is going gangbusters. In fact, where is this long-term portfolio? It is 1656. So where were we this morning? No, that's not today. Oh, that's not going to tell it. Damn it, it's the wrong part. All right. Well, 231.7, that'll tell us. So 231.7, 230, well, hasn't moved. So we're in the same position here. But the short-term portfolio is where the hedges are. And that's at 368. And I honestly don't remember when we did it last. But that's down a bit. So the long-term portfolio is up nicely. It's up 50,000 or whatever the number was, and the short-term portfolio is down about 20,000. So that's where we are. So one's gaining and one's losing. That's how it's supposed to be. So that, here's our TZAs here in this portfolio. So that's what I mean by that. You have to be balanced. If you're losing more than you're winning, then you're doing it wrong, or you're too bearish. That's all there is to it. And you need to lighten up. Will it close the gap by the end of October? I assume you mean TZA or the Russell? Look, I like I said, don't ask me because I'm doing a terrible job right now. Ah! Are you kidding? I mean, look, this is completely out of control. So as you're asking, it's getting more and more ridiculous. It looks like it's going to really jam up to 15,000 before, but 1,500 at this stage. It looks like nothing is really going to stop this thing from just going higher and higher. And the S&P is over 2,500. There's nothing bearish here. I mean, the better thing to do is to just give up on this position and move on to other things. Because you just got, it's just a wing and a prayer kind of thing to get your money back on this at this point. That's an incredible move up. I mean, it's just ridiculous in a day. Yeah, 2% move in one day. When the Dow is up 0% and the S&P is up 0.3%, this is up 2%. That's crazy. But it's happening. So what are you going to do about it? Does this have to do with the tax plan? Yeah, it has everything to do with the tax plan. We talked about that before. Look, it's supposedly Trump is telling you that small businesses are going to drastically benefit from him lowering the corporate tax rate to 20%. And they will. They'll have better earnings. And small businesses are the ones that can't afford the fancy accountants. So they need the rate to be lower so they don't have to pay 35%. You're talking about doubling the earnings of small businesses. So yeah, it's very possible this could be a permanent thing. And that's the only thing that's going to reverse it. Really, if it doesn't reverse shortly, I would give up on it. Because it basically, if this goes through, if this does what it says it's going to do, you're going to be drastically increasing the profitability of exactly the kind of businesses that are in the Russell. I am very surprised by this kind of reaction, but I mean, Beam has been known for ages, but there's not much you can do about that, is there? It is what it is. It was just a terrible time, unfortunately, to short the index. I mean, sometimes you have to realize the trade's bad, give it up. We're going to have to kill it. So we're a Progressive? Oh, Penske. So, again, it's a good solid company. There's nothing wrong with these guys. They're $4 billion. I know they're earning good money. They're earning $400 million. So they've got, P a bit over 10. Forward looking, they're looking to earn $4 a share going forward. Again, P is around 10. This is a nice little stock, pays a nice little dividend. So what's the actual question? They're great. Yeah. I mean, if I was going to make a play on them, and I would because they're a perfectly good company. PAG. Oh, so just one more thing on the rest of it. So the bottom line is, look, today is the excitement of the tax plan. You're going to get your big spiky move today. It'll probably calm down a bit in the next couple of days, but I don't know how much. But if you're looking for a huge retracement and this tax plan pans out and people like it in general, you're not going to get it. I was just hoping it would pull back to 60. I'm not even sure it's going to pull back to 60 at this point. But 1,400, very unlikely unless this tax plan is completely BS, which I have not had a chance to check out yet. Now, see, the problem with Penske is they don't have any long-term options. That's why I was wondering why we didn't play them. But still, you can make some nice money. I mean, you can sell these 45 puts for $350, and that's better than the dividend. Between now and May, you're going to collect $350. The dividend is only the dividend is $128. So you're going to collect more than double the dividend in less than a year, and your worst outcome is you own them for $45. Or was it 40 or 45? So that's a no-brainer, I think, as far as collecting cash. The 45 puts. So in other words, you're doing 45. Your net's going to be $42, basically, or $41.50 net, which is 10% lower than it is now, at least. So your worst case is getting a 10% discount on the stock. And if not, you're going to collect double the dividend. You don't even have to buy the stock. So that's the way I'd play that. I wouldn't even mess around with the other stuff. I mean, it's like, that's fine. If someone's going to hand you money like that, take the money. And that's really all it is to figure out a trade. It's like, well, geez, why go further? Why be greedy? That's plenty of money. KNB sold up and have high free cash flow. At $100 a KNB, it's 4% yield. I understand that. I'm not saying they're bad companies. I'm just saying they're not exciting. There's nothing wrong with them. If you're a dividend kind of player, that's great. But, we're looking for things that are going to have a little pop. We like something that's going to have a little kick to them as well. They'll probably just coast along they're going to coast along at whatever the rough average of the S&P 500 is. So, whatever PE ratio the S&P is getting, they're going to get it because they're solid middle row companies. And I'm not expecting anything bad to happen to them or anything like that. I just don't think they're very exciting plays. I think Morris at least has an upside that I like. TS shorts, he's still what's making the rest of them move up. Okay, so like you said, there's no way you're getting around this. I mean, nobody's talking about anything but the tax plans, like the talking point into the weekend. It's going to be really hard for the Russell to not continue to move up on this news. What are your thoughts on G? And don't forget, Europe and Japan haven't even reacted to this yet. They're closed. So this is going to get spread. It's going to get worse. So do not be in the Russell short if you can't afford to lose more money, because they're going to be very painful. Dow flat, S&P 500 flat, the Russell's up to, yeah. What are your thoughts on GEOOP position, please? Let's see. The options opportunity portfolio. GE. All right, what do we have? We have 23 calls. We have 10 short, 25 puts. We're right on the money with that. And we have the 30 short calls. I think it's fine. I mean, do I think GE is going to be higher than $23? Look, it has to be higher than 25. If it's higher than 25, then these expire worthless and we make $2 on these. What do we pay for the net of the trade? We paid, well, it's hard to see. We paid $6,000 minus $2,500 is $3,500 minus $2,000 is $1,500. So we paid $1,500, and we've got 20 of these. So since we only paid $1,500, all we have to do is be at 24. Well, not really. If we're at 25, we get $4,000 back on $1,500. So I'm not sure what the question is. Is the question, do I like it? It's like, of course I like it. It was a net $1,500 outlay to have GE at 23. To have GE basically at the break even, I'd have to say is around $24.50. If we have $24.50, we lose money on the puts. We make money here, whatever. So basically, do I believe in GE at the current price? Yeah, I think it's a good deal here. So would I change it? No, I wouldn't change it. We could conceivably take advantage of a dip at some point, but it really is going to depend on how I feel about the market. I mean, I'm nervous the whole market's going to pull back, so I haven't been jumping on improving every position. But we did. I'm sorry. We bought back half of the short calls because I improved it when it was down here. We bought back some of the short calls. But at the moment, I'm not looking to do much. I do expect it to get back into like this 27 area. But I'm also concerned the whole market's going to sell off. So I'm not jumping on the trade. But do I think it's a good solid trade? Absolutely. Am I comfortable with where it is? Absolutely. You can also roll it if we want to. So down the road, if we are worried about it, we can always go to 2020. Oh, there is no 2020 yet. So when there are 2020s, we can go to 2020. But as it stands now, I wouldn't mess around with it. Is pulling back because of civil lawsuit, is that a buying opportunity? Yeah. What? Who? GE? Who are we talking about? GE. Yeah. I think it's great down here. I think it was great. We've been playing it ever since it's been down in this range, so I definitely like it. Thoughts on DBA 219, which I haven't rolled to 2020. Word is October when grain starts to pop. Well, yeah, we like DBA too. I mean, DBA is DBA in the option opportunity. DBA. Oh yeah, so it is. So we haven't rolled these either. We've got the 19s This is a year from now. Again, this is an inflation hedge more. This particular, in the options opportunity portfolio, we have our hedges as well as our long positions. This is an inflation hedge, DVA, and we've got the 19 calls. We have the 17 calls. We own the 17 calls. So we have a 17-19 spread, and we sold the $20 put. So we were aggressive in our put sale. We sold the $20 puts for 2, so our net is 18. So at $18, this cancels out. And then what we've got is a 17-19 spread that's 100% in the money. So again, do I think DVA is going lower? No. At the moment, it looks bad because the 17s are showing a large loss. But who cares I don't care what it looks like. The 17 calls are in the money. The 19 calls are just out of the money. But the point is, we're going to collect. We can't collect more than $2 for this spread. It's not pricing us that way, but we paid. We paid $8,400 for the 17s. We sold these for $3,100. Why did we do that? Why would we have a $2 spread? I don't know. I honestly don't remember why that happened. I assume that we must have changed the position somehow at some point because it doesn't make sense that we would have done it like this. Because according to this, we have a $2 spread. I imagine what we must have done, 818, 820. Oh, we adjusted the whole thing recently. Okay, so whatever it is we did recently, we made these adjustments. So these aren't our net prices. That's why it's a little bit confusing looking. But the bottom line is this spread, if all goes well, we'll collect $4,000. And currently, the spread's value is $5,000 minus $3,000 is 0. The net of the spread right now is 0. So you could double this spread and have double 0 for the cost. It's $57.50 minus 33 minus 25. So that's the credit balance on the spread. So if I were to double this spread, then you would be collecting another $4,000 at the same price, at the price it is now. So all DVA has to do is not go down. So no, I'm not interested in changing this. When 2020s come out, I'm probably going to want to roll, especially at this kind of loss. I definitely would want to roll. I mean, from 822, so from just a month ago, this thing is down from 420 to 288. That's a crazy difference. So I'd want to take advantage of that and roll out to 2020. Are 2020s out? Let's take a look. DVA. That's the thing. Whenever you have a position that's down, you say, how can I use it down to my advantage? If that's down, then the long. Oh, here's 2020s. So if this is down, the 17s are 285. That means the longer ones must be down too, right? So for 285, oh my God, look at that. Whoa. Oh, these spreads are so wide you can't even deal with it. That's the problem. All right. Let's say we move to the 15s, which are 490. So it'll cost us $2 to roll the 17s to the 15s, and we're going to pick up $2 in position and 2 years and a year in time. So that's a good adjustment. It's a worth $2 adjustment, and at the same time we sold what puts did we sell? We sold the $20 puts. And they're just about $2. So then we have the $20 puts that we sold here, which are $175, let's say. And we can roll them. It's not worth rolling. Why would I roll them? These guys are only $2. If for 25 cents, I'm not going to roll them. So we leave those. We're not going to change that. So on the whole, though, we could spend $2 and roll it. And here's what we could do. This is a fun way to do it. We could roll to the 15s, which we said is going to be let's say 490. So we're going to spend a couple of bucks to roll one set. Then we add another set where we buy more for 490 and sell, let's say, the 20s for about 180 or 185. So $4.90 is $3. So we could add another spread, and I don't like $3. $3 doesn't seem like a good deal. 15 to 20, that's a ripoff. So $3 for the $5 spread is not that exciting, but if we could get a better price, something like that would be interesting to sort of double down on the position. So in other words, we could add, so we roll the ones we have here out to here, then we add another set that's covered for $3 more, and then we're going to have like 40 of the 15s and 20 of the shorts here. And then the idea is that we're covered over here on these 20s, and when they expire, we're going to roll them out to a longer one, and then even lower. Oh, and then we lower the price some more on the rest. So actually, we would end up with a nice net on the spread. So something like that. But I know it's always confusing when you start talking about like what are we going to do then, and then 3 times later, and then 6 months later. It's like explaining a football play and then talking about like you have the initial play, then you're like, well, if he runs there, then you do that, and if he runs there, then you do that. There's a lot of moving parts on these things. But the bottom line is I'm very comfortable with all the different things we can do. Therefore, I like to trade now. That's the easiest way to say it. When I can look at all the layouts and I see like 10 different things I don't mind doing, then I say, well, there's no reason to change this trade right now. There's too many good things that can come out of it. Yeah, TF is relentless. Would you cover the OOP LB position now that it's had a nice run, or leave it? That's tricky. I love my LBs. But on the other hand, that's not our job, right? We're not here to love our positions. We're here to cover sensibly. I'm not really into covering it until it's getting closer to the 200-day moving average, frankly, which is 50. It's a long way up. Wow, what a shame. This was such a good trade of the year idea, too. See, it's not going to be the trade of the year because I don't believe in it. It's just it was such a good trade of the year down here when I started talking about it, but now it's kind of moving up out of the zone. Which one were you talking about? Was it the in the OOP? Is this the OOP? I can do it. Yeah. So LB, we got all aggressive with it. We have 20 of the 40 calls at 735. They're at 770 now. Cheated when that happens. It's a little irresponsible not to cover, but as long as the market's heading higher, then there's no reason to jump on it. So at the moment, I'm going to say no. But I may change my mind as we get closer to rollover time. Oh, look at that, a little teeny pullback now. See, now here, well, I should have looked at that before. 15,000 down, Jesus. Where is this thing? There. See, had I added more at 490, 490 was 30 points up, so each one would have adjusted me $2 higher. So then two more ads would have pulled me to, I could have added 2 and gotten up close to 65. That would have been worth it. Remember I talked about it not being worth it before? Going to 65 would have been worth it if I caught 1490. Now I'm not as excited. But if I catch 1490 again, I'm going to add a few, probably 3 until I get this number up to 1465. Then that becomes my break even. I get the hell out. I really can't take it anymore. It's just so annoying. I mean, I have 13 now, so that's a lot. I mean, losing on each position. So that's not good. Oil's also being very annoying, but it's not out of range. This is just, well, look at this. This is these things generally hold. So here's resistance 1, resistance 2. This thing just blew through 5, 6, 7, 8 standard deviations higher than it should be. That's just absolutely insane. The crazy one-day move. And I'm fairly positive half of that move will be erased back to 75. But what happens after that is anybody's guess. And that's why it would have been nice if I raised my basis to 65. At least I can get back in the ballpark. I'd only be down $5,000 at that point. as it stands now, even if I get back to 75, I'm still going to be down, I think like $7,000-8,000. And again, it depends on the actual reading of the tax information to see what we actually think of the effect of this on the small businesses, and also whether or not it's going to pass in the first place. The Republicans are coming out with this plan and talking about how great it is for small business and this and that, but nobody's really read it. They're giving all the talking points because they want to make Democrats look like dickheads when they say they don't like it. That's their whole goal. That's what all this is about. And also they're almost certainly going to change it along the way to make it much more favorable to the top 1%. But they're not telling you that right now. But anyway, so that's my predictions. Mark my words. Robinson, what? Oh, here. On TF, why don't you buy and sell at the top and raise your average? Why don't you buy and sell at the top to raise your average? I don't know about buying. I mean, if I sold more, then yeah, I understand what you're saying. I mean, I just went over that, right? I mean, I would have done it. I just had to add a few more shorts, and I bring my average up, but I have to feel like I'm confident going back down, otherwise I'm just losing. Like the 3 I added, what did I add those? They were 1470 when I added them? I didn't want to think about it. I just added 3 when we were, all right, well, we can see, because when we first started talking about it, yeah, way over here, somewhere around here, I added 3. And those 3, just by themselves, are down $150 times what, $3,000. So I lost $3,000 on the 3 I added since we started this webinar. That's on the 3 I added, not even counting the rest. So I'm not going to add more unless I feel there's resistance, and I'm concerned that there's no proper resistance until we get to 1,500. Now, unfortunately, I think that the other indexes aren't so hard to boost, and hopefully they're going to calm down a little bit, but everybody took a huge pop. But and again, there's a reason. I'm not going to knee-jerk short something if there's a fundamental reason that you can justify the move. And I can justify the move because if you have a tax plan that's geared towards lowering the tax base of small businesses, the tax cost of small businesses, it's going to bump up their revenue and give them better valuation. That's a pretty simple premise. And believe me, I'm critical because I'm a liberal Democrat. I'm critical of the things that most people who are investing are not. They're like, oh, great, this is good, but they're not questioning anything. They're not looking deeper into it. They're taking these guys at their word. They're talking right now. I think that's what they're talking about. Yep, they're telling you how great they're telling you how fantastic they're making America by cutting taxes. Just like everybody else who cut taxes and made things fantastic. It's funny, because they say America's not great anymore, and meanwhile, taxes have been cut, stayed cut again, and stimulus, and still America somehow isn't great, even though they've had their way as far as cutting taxes goes since like the 70s. So we'll see. But what a mess. That's where we stand now. So, getting back to it. So the important thing, though, let's refocus on something. I don't mind losing $15,000 on my TF shorts because I'm mostly long. Our portfolio positions are long. In the long-term portfolio, we have what do we say it is? $1.6 million of long positions. All long. Every single one of these is a long position. And we started with $500,000, so we're protecting $1 million plus gain. And look at the cash. Out of $1.6 million, we have $1.2 million practically in cash. So 75% cash. So it's already protected, but that doesn't really make me happy. I've got $491,000 worth of longs in market value, and we have in the short-term portfolio, we only, well, I don't want to say only, but we have $250,000 worth of hedges. So here on SQQ and on TZA, we have about 250,000 plus the FAS over here. We have about $250,000 worth of hedges. So that still is going to hurt if the market really sells off. So on additional hedges are these future plays. So I'm not going to play the futures long because I've already got plenty of longs. I'm playing the futures short in case something happens and turns down. That's when I want to have some fast cash. And meanwhile, also, you have to also consider, and when you're playing these things, another reason to have a long-term, short-term portfolio. The long-term portfolio is like long-term IRA money, 401k money. That positions you want to gain your money in. If I'm going to take a loss, I want to take a loss on my short-term trading because that way I have tax deduction. No good to take a loss in your long-term portfolio. You don't have a tax deduction. Take a loss in the short-term portfolio. That's where you get your deductions. So, always have to consider that also as far as it goes. You want to have those offsets. If you need to move, you want to be strategic about how you're doing your trading as far as that goes. And that's a more advanced thing to worry about, but it's something that you should be considering when you're trading. But your futures loss is real money versus a virtual portfolio. Well, no, we have we have long-term. I have long-term investments, so it's all real. just like keeping a virtual portfolio, that doesn't mean we don't have long positions. So, this portfolio is just a webinar portfolio. It's not even an actual thing. It's just something I put some money into to do examples for the webinar. So mostly just for fun trading this thing, it's a side thing. But so it's why honestly there's no difference than with virtual here. It's not like an account I'm sitting there worrying about every day. But the point being that this is where you want to do your short-term moves, and if I make money, I make money. If I lose money, I lose money. Whatever. It's not a big deal. But the hedging is always going to be to the downside. If you're more invested in the upside, now if you're bearish, you want to hedge more to the upside on this, in which case you'd be having a fantastic day. But since my overall positions are long, I'm worried about that side. Now, here's an interesting thing, because gasoline came down nicely, and I like 165 for long. Remember, we like to go long on gasoline into the weekend? So oil's up, gasoline's down, and we're heading into the weekend. Let's take a quick look at the API report and see how it looks. All right, blow that up. So we had a 1.8 million barrel draw in crude. Gasoline inventories increased 1.1 million barrels. And finished gasoline decreased, blending components, blah, blah, blah. Distillate fuel increased by 800,000 barrels. And propane decreased by 2.4 million barrels. So then we got to look at what actually happened here. First of all, look at the imports. 7.3 million last year per day. Last week, 6.5 million. This week, 6.2 million. That's 300,000 less per day. That's 2 million less barrels per week of imported oil. So there's your whole drawer in oil. It's caused by less importing. Exporting, 60,000 less went out. It's still quite a lot. We are exporting a lot less, though, than we did last year. We're exporting almost 1 million barrels a day less. And that's because the channels were disrupted. But the total, interestingly enough, is not very different. 5 million net, 5 million net. So that's where we are. We're pretty steady on the net. Look at the product supplied. 20 million a day, 20 million a day. Really no difference. Gasoline, barely a twinge. Didn't go down. Gasoline. Here's gasoline, barely a twinge down from here. It's actually up from last year in supply. Distillates, up quite a bit from last year in supply. Other products, down a little bit from last year. Speaking of all other oils, there's a slight draw in all other oils here. Here in crude and STR, we know that a little bit was released. Wow, look at that. No small change in distillates, a small increase in motor gasoline, and a small decrease in crude oil. So there's really not much going on here, but the bottom line is, compared to last year, look at gasoline, 258 versus 224. So we're up like more than 10% overall. And oil, forget it. I mean, oil was $44 last year, and now it's 50. And today it's 52. So is all this justified? And again, this is the same kind of thing. Like today, we're excited about the taxes. This weekend, they were excited about OPEC, and we've got the war talk. You have war talk from Turkey, was threatening threatening Iraq, the Kurds in Iraq, and cutting off their oil supply. It's only 300,000 barrels a day. It's not like going to change the world or anything like that. But any excuse on the disruption of oil. Then you've got the whole Qatar thing is still going on with Saudi Arabia. China is filling up their China built another strategic petroleum reserve, and they're filling it up. I mean, imagine how much oil China is using. If our strategic petroleum reserve is 600 million barrels, and China just built one. They didn't build one with 10 million barrels. They built 50 million, 100 million. Who knows what they built? But they're filling it up. So they're filling that up at maybe 10 million barrels a month or something like that, or 10 million a week. I don't know. It depends on what they're doing. But if they're filling it up at all, that's a huge impact on global demand, and they consider that demand, even though ultimately the oil is being stored. So just because China started buying oil, they add that to what they consider demand and act like it's going to continue, but eventually they'll fill it up, and then they won't need any more oil until they build the next one. So I'm a little dubious as to how sticky this is going to be on the oil. But meanwhile, on the gasoline side, that's what we really want to look at closely. So motor gasoline, we have a very small build from last week. We're certainly down from last year. Gasoline is more than 10% higher than it was last year. We're exporting. Here's the big thing, though. We exported so much less. So the gasoline build of 1 million barrels is after we're exporting much, much less gasoline than we have been. So as soon as these shipping channels are cleared up, this will head back towards 2 million a day. And that's going to make it draw in gasoline very quickly. So I definitely like gasoline long. And let's even add that right now. Let's take a look at that at 165-ish. Just under 165, so that's a good time to pick it up. So let's go to RB. And let's see, buy one right here, hopefully. Will it fill? Oh no, look at it pop up. Oh, come on. That's not nice. Nobody wanted it until I said so. Now there's 3 people attempting. Oh, look at that. Guys, don't capitulate. Wait for it to come down to your price. Now I'm going to have to capitulate. I definitely want it before it crosses 165. I'm only going to buy one, though. I'm not going to buy 2. I'm going to buy 2. Huh? Come on, a little lower. The lower our waist. Somebody filled that one, and now it popped up. See, there's no real demand. It's just you guys doing it, right? Come on, admit it. You guys are overpaying. Patience. Patience, patience, patience. Come on, who's going to give in first? We have 1 guy offering to buy and 3 guys offering to sell. I bet if I hit this price, it'll sell. Let's take a look. Let's try that. Right there. Now we're up 4, 3, 2, 4. They're trying to pretend they don't really want it. Yeah, somebody leapfrogged me. There we go. See? That was a big difference. And now immediately it comes back down. Oh, maybe I will get my next one. You see that though? That was probably saved $20 by sticking to my guns and not chasing it. Not $20, probably more than 20. How much is this gap? Probably 40, $50. It doesn't pay to chase, okay? All the times you chase, if every time I capitulated on $50 and I do, I got to do this like 30, 40 times a week. So let's say 30 times a week times $50. That's $1,500 a week. Just because I'm not patient. It doesn't seem like much each time you do it, but you really have to think about how this stuff adds up on you. You've got to get your price, and if you don't get your price, walk away. So we're talking about, like I said, $1,500 a week, $75,000 a year. If I have a different habit, so the difference between making $250,000 or making $150,000 is basically whether or not I have the patience to get my price. And if I don't get my price, I walk away and I just don't do that trade. Because you know what? I have a $75,000 advantage by only doing it when I get my price. That's how you've always got to do these trades. Oh, and now we're over 165, see? So I did exactly what I wanted to do. I got one in before it got away. Well, there's one sale at 165 anyway. All right, so now I've got a price. I know where the bottom was. It was at 164. So if we do go to 164, I'll add another one. That'll make my average about 1645. And then I have to have faith in the normal pop in the weekend. Now, gasoline is $4.20 per penny. It's a very fast-moving contract. So $4.20 per penny means I'll make $1,000 at 166.5. And believe me, if I make $1,000 by Friday on this trade, I'm going to take it off the table. Because again, it's a week. On one contract, I make $1,000 in a week. That's good money. That's $50,000 a year playing that way. It's a very simple trade. We do it almost every weekend. We wait for it to bottom on Wednesday or Thursday, and then we jump in and pick up a few gasoline contracts. Right now, one contract is plenty. And we'll see how that one goes. Meanwhile, and again, that's why this doesn't bother me so much, although it sucks, but easy to make up. Just make good, sensible trades otherwise, and you can make it up. So you can have one that goes horribly against you and make it up by some sensible trading. Not that we like the one that goes horribly against us, but my goal right now is to make $15,000 another way to cover that and let this one ride, because I really still believe it'll pull back at some point. Just don't know when. And again, when I say pull back, I mean to 1460. I don't mean to 1400. It's not going to magically fix everybody's trade. All right, got to go, but let's see. A couple more. How can we follow your BNN portfolio, and where do you post it, and how do you feel about IMAX long? Wow, that's awesome. All right, the BNN portfolio is posted at Phil Stockworld / Money Talk. That's one thing. So the updates are there. We don't update it every day, but it's updated once in a while. I call it the Money Talk portfolio. It's currently up 20%. Very nice. In fact, it's up 10% from the other day when we were talking about it. Oh, because Apple recovered. Because Apple was down. Remember I said it was still a good time to buy it? So Apple recovered. Was it Monday or Tuesday? When was that? Yesterday? That's funny if it did that in a day. Oh, no, that was up 22. Okay, so at one point this was down. Oh, that's the wrong portfolio. This is the NASDAQ portfolio. How confusing. This is the NASDAQ portfolio. This is the Money Talk portfolio. This is the Apple trade from that one. And this was down. See, it was 14.7 minus 11 is, well, basically zero. So this was pretty much net zero yesterday. And now, Money Talk. And today, I know it's up $10,000 because that's the change in this portfolio. Where is it? Oh, there it is. Nope, still net negative. Why am I confused then? Is that the same position? 2010. So it was net minus 14. Oh, I'm sorry. I did the math wrong. That's what. It was minus 14.7 and 3 is 17.7 plus 11 is 6,000. So it was minus 6,000 yesterday. Ah, that's where the difference is. So that was minus 6,000 yesterday, and today it's about even. That's the change. So that one position has picked up $6,000. Then there's been some improvement in IMAX, which of course I still like. Although look at the gain on that. Holy cow, that's a really nice gain for this amount of time. And LB, of course, we just talked about how much I love them. And Wheaton Precious Metals I love. Boy, I love this portfolio. I got to tell you, some damn good picks. They want me to do a full-time show up there. I just can't. I'd have to move to Canada. I can't even think about that. I was like, that's a big commitment. Let's see, where are we? Apple, what are we talking about? Oh, IMAX, right, sorry. So IMAX was, it was $6,200 minus $2,600 minus $2,350. So we netted in for $1,250. And how much can we make? It's a $4 spread, that's 20 contracts. So we can make $8,000 back on it. So the net we can make is $1,250 minus $8,000, $6,750. So we can make $6,750 profit. Currently, the profit is $5,600 plus 1,225 minus 3,550. So we're like halfway there already. We made half the money we intended to make by March in a month. So this gets back to one of the things. Is the question is, do we really have enough faith in IMAX to say, I don't feel the need to sell this, even though we made half our money already? We want to save it for another 6 months to get the other half of the money, because now we're risking all the money we gained. That's when it gets tricky, right? Like we already have this, so we take this profit right off the table. But then I have to say, well, you know what? I have complete faith in IMAX. I never doubted for a second it was going to pop. And I don't see any reason why it won't have a fantastic fall because of you got Star Wars and everything else going on. You have a lot of good movies coming out. The whole sell-off in IMAX was idiotic. That's why it's banging the table on things. It went down. So, yeah, I don't see any reason why it won't be up there. Oh, isn't that funny? So the same place, isn't it the same exact target as LB? Or was LB 47? 27 there. 47. I'm sorry. Like you have practically the same targets. So I love this portfolio. It's fantastic. So it's still stockworld.com/money talk would be the latest update of the portfolio whenever I get around to doing that, which is probably like every other week we'll be posting it up. But holy cow, are those good positions. And then you have to tell BNN, Money Talk people, and say, when's Phil Davis coming back on to update the portfolios? That's important. That's when you get your new trade. I can't make a trade in that portfolio unless I'm on the show. So yes, we have to basically just wait until I do the show to make the next trade. So talk about passive investing, right? To be clear, the amount we see on the futures board is real or paper money. This thing is real. This is a portfolio. That's real. Don't remind me. That's real losses right now. Are you still bullish on SunPower and the OLP? I still like SunPower. There's some nonsense going on with them. What was in the news today? I forget. Morgan Stanley cut them to sell with a nasty $6 price target. And they're worried about a trade ruling against them in the solar sector. The whole solar is the overcapacity in the solar sector, blah blah blah. Now, and then there are penalties imposed by the government on a trade case, and most of their revenue is generated in the overseas manufacturers, so they have to bring stuff in from overseas. Basically, Trump. Team Trump is trying to kill the solar industry to give coal an advantage. But, I don't think you can turn the tide on this. I think you may have to sort of ride it out if there's a downturn. So where do we have SunPower? In the OOP? It's not like I don't believe in the positions. I just think you're going to have to decide whether it's worth riding out. We have the 5-10 spread for 2019. We're in the money, and they're at 7. No, I think if anything, if it actually sold off, I'd be more inclined to press the position. Because as a long-term macro, you can't stop solar power. And plus, we sold these $7 puts for $255. Our net is $445. So do I believe in them at $445? Yeah, absolutely. I'm not. And so basically, all I would say to this is if this thing drops significantly, I would be very happy to roll these to the $2026 calls, and we'll just wait longer to get paid. So it's an opportunity to buy more of something I like anyway. I'm certainly not going to abandon them just for that. What's volume today? I don't know. Let's take a look. SPY. The same. We haven't cracked 60 in ages. Look at this. 45, 46, 47, 59, 48, 51, 57, 48. We're not going to crack 60 today either. You know, it's not unusual that we have these low volume days. It's 50, 50, 36, 57. But there's at least some 60s in there. Every once in a while, there should be 100. Like people should, once in a while, people should make some trades. You know, but if you go back, where were we last fall? All right, look at last October. 120, 117, 80, 120, 70, 60, 90, 50, 130, 73, 193. So we're off, significantly. We're like doing 2/3 of volume we did last year. And that volume was half of what it had been in previous years. So the volume on the exchanges is drying up to like nothing. There's so little trading going on. It's just absolutely crazy. Why aren't you using November RB contract? Doesn't the October contract expire at the end of the week, which may be causing the light volume? Is that true? Are we in the, yeah, you're right. We're in the October contract. Nope. Well, November's better then. So that's going to be what? X7, which is lower, which is 162. So yeah, if you're going to buy another one, I'd go the RBX7. The same thing. They're going to move essentially the same way, not too different. They're both down, and they're both where they are. I just picked RB because it's right there, and basically we intend to get out of it by tomorrow anyway. I mean, not by tomorrow, by Friday. So look, right now it's down $142. So I can buy another one. I'm waiting to see if it, like I said, I want to see if it hits 164. And if it doesn't, then I don't need to double down. But if it hits 164, I'll double down and get a good price. All righty, so we're going to wrap that up here. I've got to get going. And let's just take a quick, make sure we know where we are with our portfolios. We've got the OOP, 288%, very good, almost 300%. That's amazing. I mean, and that's from only 2015. It's just over 2 years old. And we're up almost 300% on that one. Butterflies, this will be interesting. Butterflies are up 300%, but it's an older portfolio. It's actually our oldest portfolio. It's from 7/29/13, a few months older than our other two portfolios. This one is exactly this. All we're doing here is sell premium, sell premium, sell premium. That's the whole point of this portfolio. The Jill portfolio is a NASDAQ portfolio. This one's dead, though. It's really just closed out. This portfolio is dead because the NASDAQ doesn't want us talking about. The NASDAQ's logic is they said, we don't want you talking about specific stocks because it seems like you're favoring one of our clients over another, which is the most ridiculous thing I ever heard. But that's what they said to them, and not to me, but the people who interviewed me. As we said, the Money Talk portfolio is at 20%, which is very good for, when was I on there? 9/6. So that's not even a month, and we're up 20%. Short-term portfolio we just looked at, that was 588, something like that. 465. So it's up 360%. And the long-term portfolio, which is the most important portfolio, because most of your money should be in long-term wealth-building positions. That's how it should work. And we have these articles in the education section, right here on Phil Stockworld. We have this section, education. And if you go through the education section, you'll come to some articles that are talking about, and also it might be also in the portfolio section, called Smart Portfolio Management. And we talk about constructing and building these portfolios, which is exactly where these things came from. That's what we did over time. And in the $1 million portfolio section, we only started this one with $500,000, but the same concept. In the $1 million portfolio section, we talked about you start by selling short puts, because that way you're guaranteed to get your stock at a discount. Then you develop your position, and you try to collect dividends. If the dividends are worth collecting, you buy the actual stock. If the dividends are not worth collecting, then you just set up bull call spreads, which are artificial ways to own the stock by having a long bull call spread. But the most important thing, and the theme of every single thing we're doing here, is selling premium, selling premium, selling premium. You sell the risk to other people. You're not the one that should be taking a risk. You're the one that should be investing. There are plenty of people who want to bet your stock is going to go up or down. If you own the stock and you sell a risk to somebody who says it's going to go up, you cannot be harmed. Okay, if I buy, look, again, let's go back to good old GE. That's such an easy example. So step number one, find a stock that has value. So GE at $24 has value. I can't even conceive of it going below 20. So I'm buying it for $24.37. I'm going to sell the $23 call for $2.70. So I'm going to collect. So that's going to drop my net to 22, and 70 minus 40 is 70. So 21.70. That drops my, just selling these calls drops my net to 21.70. So I buy the stock, I sell the call. Then I sell puts, the 23 puts for $1.60, and all I'm doing is saying I promise to buy this stock if it's $1.60 below 23. I mean, if it's below 23, you have to buy it, but you're collecting $1.60, so your net becomes $21.40. So my worst case scenario is I end up doubling down at $21.40, which is 15% below the current price. But meanwhile, I buy the stock for $24.40. I sell the calls, the 23 calls, for $2.70. So my net is $21.70 minus $1.60 is 20. So my net is 20, and I'm going to be called away with a 15% profit at 23. So if G is at 23 or above, I'm called away with a 15% profit. And again, when it gets to that point, I may roll the position or change it or do something, but the bottom line is I'm lining myself up from $20 to make $3. And that's in 16 months. I'm going to make 1% a month versus putting my money in the bank. Also, I'm going to collect a dividend. And GE pays $1, basically, in dividend. So I'm going to collect 5% a year dividend plus 12% in my 1% per month. So annualized, I'm collecting 17% on my money on GE. That's all it is. So am I taking a risk? Sure, I'm taking a risk of owning GE at a net of $22, which is 10% below, more than 10% below the current price. So my risk is owning GE cheaply. That's my risk. That's why I say you're an investor. I take a value stock that I would be very happy to own at 10% below the current price. Then I buy it, I sell puts, I sell calls, and I wait, and I collect 17% on my money. This isn't exciting. It's nice. And it's something you can do with sideline cash. GE is not a play that we look to. We're not making 50% returns on our portfolios every year by playing all GE. But in a long-term portfolio or in a portfolio where you want to make a nice little safe dividend, it's a nice thing to do with your cash if you can't find better plays. And the reason GE went in the options opportunity portfolio, I think it did. Oh, no, it didn't. Sorry. My portfolio. Oh, no, that's the long-term portfolio. I thought it was in the options opportunity portfolio. Let me see. I believe it did, though. Yeah. Sorry. we didn't do the stock. We did an artificial in GE. But anyway, so the reason in the long-term portfolio that we put GE in is because I got all this cash sitting there. I've got $1 million something cash. We've got to do something with it. So some things I'd like to make some money on. So we make a little bit of money on some of the cash. And like I said, if I make 17% on $50,000, that's $7,500. That's a nice rate of return. That doubles the return I would have on $500,000 if I just stuck it in the bank at 1%. So it doesn't take a lot of those kind of plays, and it's not a big risk because my downside is owning GE. Again, if you think it's meaningless and you don't believe GE is worth, you don't know what GE is worth, then it's not a good trade. But you just pick a stock you do think is worth something. For excitement, we go to something like LB because you do the same trade with LB, except LB doesn't pay a dividend. So instead of owning it at all, I'm going to sell the 35 puts for $4 or $4 whatever. It doesn't matter, $4. And I'm going to buy the 40 to 780, and I'm going to sell the 50s, let's say the 50s for $4. So that's 380 minus, what do we say we're going to sell these? Minus 4. So for net credit, I'm going to have a $10 spread. So now I spent nothing, and I have a $10 spread, and my worst case scenario is I'm buying LB for $35, which is 20% below the price it is now. And I want that to sink in, okay? We're selling the risk to other people. Some guy is paying us $4 to promise to buy LB for $35. We're investing in the $40 calls, $770, whatever, $780. We're investing $780 in the $40 calls, but then we're turning around and selling them for $4 of the $780. We're going to turn around and sell to a guy who thinks it's going to be above $50. That guy's a sucker. We're not a sucker. Our $40 calls are in the money, and the net of the money that we're spending is $380. But then because we're also selling the 35s, we're actually getting a net credit. So we're taking, the only risk we're taking on this trade is the risk of owning LB for $35. We've got no cash on the line at all. Yet we can make $10, which is 25% of the whole price of LB. We can make $10 if it gets to $50, which is just what we make on the stock, except we don't have to buy the stock at all. That's what I mean by being the house, okay? We're the casino. We're not gambling, okay? We're taking bets. I'm taking a bet from a guy who wants me to buy his stock for $35 in case it goes lower. I'm like, okay. And I'm taking a bet from a guy who thinks it's going to be over $50. My investment is in the money position. But mostly I'm selling. I'm selling more premium than I'm buying. And I make, if there's a spread, I'm going to make the spread. If there's no spread, I'm going to buy a stock cheaply. That's my entire downside, is buying a stock cheaply. And if you do that with stocks, if you value your stocks correctly and you pick up stocks at the right time, then you don't give a crap whether the market goes up, down, or sideways. You're going to make money. Now, LB, not really a blue chip, although Victoria's Secret, I'd have to argue, it's a pretty damn good blue chip retail. It's not likely to disappear in the next few years. Obviously somebody said that about Sears at some point and they were wrong, but so it's not definite. But you get the point. In other words, GE is a safe one. It pays 17%. That's one I think is that one I don't mind putting a huge part of my portfolio in. This one I wouldn't put as much of my portfolio into it. But on the other hand, the returns are phenomenal. If I risk buying $35,000 worth of this, all I'm doing is I'm risking the possibility of buying $35,000 worth of stock. I get $10,000 in profit if it just gets up to 50. That's our whole system. That's what we teach people to do. And I don't have to day trade, and I don't have to sweat the positions, and we barely touch our long-term portfolio because this is so simple. It has only if a catastrophe strikes do we worry about it, and even then we have the short-term portfolio with all the hedges to back it up. That's how I want you guys to learn how to play. But it all starts out very simple. Take blue chips, take good, solid stocks at good, solid values, and there's always some that are cheap, so you don't have to chase anything. And then sell the risk to other people, and then wait patiently to get your money. That's all there is to it. I don't know any better way to build wealth in a market portfolio. I really don't. So it's a system we stick with. It works. It's worked for years. It keeps working. And somebody even asked me today, like, will this work in a down market? It's like, yeah, it will. You'll lose money, but you'll lose a lot less than everybody else. And then when the market comes back, you'll have bigger positions than everybody else because you didn't lose as much on the way down. Not foolproof. If the market drops 20, 30%, you're going to lose some money because we're only hedged to about 20%. Now, we could add more hedges. Again, nothing static. You can add more hedges on the way down. We've got plenty of cash. But you're going to take a loss, at least on paper, while it's going on. And if you have a horrific crash like we did in 2008, you can lose 40%, 50%. But you know what? Having 50% of your portfolio intact when the market sells 60% is great. The opportunities were incredible at that price, but you've got to be able to deal with it and get liquid and move back and then pick out the bargains, which is what we did back in 2008 and 2009. And hopefully that won't happen. And that was unique. I don't really see that happening. I'm looking for a market correction of 10 to 20% from where we are, but that doesn't mean I think they're going to have a major crash. I think a major crash is off the table, at least in the near future, because right now the Fed and all the other central banks would never let that happen. And so until they've exhausted themselves, it's highly unlikely that we have more than like a 10 to 20% correction, because they'll step in and they'll start doing stuff again to get us back. So it's not even something I'm worried about. So we basically hedge for a 10% drop in the short-term portfolio. If there's a 20% drop, we won't do that great, but we'll be okay. And if there's a 30, 40% drop, we'll be surprised. But right now, a 20% drop, I would love it because we'd have so much cash that we could jump in with to buy stuff. It would make me very happy. All right, time to wrap this up. We're a little bit over time. Thank you, everybody, for coming, and we will continue this conversation next week. Any last questions? Why did you sell the 21 call and not higher? Well, sorry, Chris, I'm not sure which one you mean. But why would I sell? Whichever one I was talking about, because I'm conservative. I'm looking to minimize my cash outlay and pick something that's going to give me a reasonable return. Okay, look, when you're making 300, 400% back on the cash you lay out, you don't have to be greedy. And in fact, the benefits of protecting yourself and being conservative over the long haul far outweigh maximizing your profit in the short run. So that's what it's about. And again, we want other people to take the risk. We're not in the business of taking a risk. We're in the business of building our wealth. That's what this is all about. Other people can take the risk for us. We're the investors. We don't gamble. We're the guys who own the casino. We invite other people to play and make bets on whether our stocks are going to go up and whether they go down. We take bets on both sides, and it's very, very hard for us to lose. That's the goal. All right. Thanks, everybody. Have a wonderful day, and I'll speak to you next week. Take care.